I've spent the better part of 7 decades thinking about how capital works, how businesses create value, and why most people completely misunderstand the nature of wealth accumulation. What I'm going to share with you today might contradict much of what you've been told by the financial services industry, and that's precisely the point. People constantly invoke Einstein's alleged quote about compound interest being the 8th wonder of the world. Whether Einstein actually said this is questionable, I've always been skeptical of conveniently attributed quotes. But regardless of its origin, this statement has been weaponized by the financial services industry to sell products that primarily benefit them, not you. The financial advisory business has built an entire mythology around compound interest that goes something like this. Start saving early, earn modest returns, reinvest everything, and by the time you're 60 or 65, you'll be wealthy. This narrative is mathematically sound, but practically worthless for most people, and I'll explain why. I recently heard a story that perfectly illustrates the fallacy. Someone told his friend to quit smoking, calculating that the money saved over 20 years, invested with compound interest, would buy a Porsche. The friend asked, "Do you smoke?" The advisor proudly said no. The friend then asked, "So where's your Porsche?" You see the problem. The theory is beautiful, but the execution reveals a fundamental misunderstanding of how wealth is actually created. Let me talk about Warren, my partner for over 5 decades. People constantly misrepresent how he became wealthy. They claim it was compound interest, as if he saved his allowance and let it grow for 60 years. This is completely wrong, and it does a disservice to understanding what actually works. By age 32, Warren had accumulated over $1 million in 1960s money, equivalent to roughly 8 or 10 million today. How did he do this? The average American salary then was about $3,000 annually. You cannot compound $3,000 into $1 million in a few years through traditional savings and investment, even with exceptional returns. Warren understood something fundamental that most people miss. He wasn't practicing compound interest in the way financial advisors mean it. He was practicing capital aggregation and leverage. At age 26, he raised $100,000 from family and friends to start his investment partnership. 6 years later, he had multiplied that tenfold. Notice 2 critical elements here. First, Warren's returns were extraordinary, but extraordinary returns alone weren't sufficient. Second, and this is what people consistently overlook, he used other people's capital from the very beginning. This is leverage, not in the dangerous sense of borrowing to speculate, but in the intelligent sense of aggregating capital to deploy at scale. Warren has consistently used financial leverage throughout his career, but his cost of capital has been extraordinarily low, often zero or even negative. Think about what this means. He invests other people's money, and they pay him for the privilege through management fees. Whether his fund makes or loses money in a given year, he collects management fees up front. When there are profits, he takes a percentage. This is a completely different game than what retail investors play. Furthermore, he owns insurance companies, perhaps the most brilliant source of low-cost capital ever devised. Insurance companies collect premiums up front and pay claims later. That float, the money sitting between collection and payout, costs less than nothing because policyholders are actually paying for the insurance coverage. Warren has deployed hundreds of billions in float over the decades. In 2002, Berkshire even issued the first floating rate security in history. He wasn't playing with compound interest. He was playing with financial architecture. Everyone knows Jeff Bezos got rich through Amazon, Mark Zuckerberg through Facebook. People understand that entrepreneurs build businesses and become wealthy through ownership. Yet somehow, when it comes to Warren Buffett, people think he got rich merely by investing in the stock market, as if he were just a sophisticated retail investor. This is a profound misunderstanding. When Warren buys stock, he's not buying pieces of paper to trade. He's acquiring businesses or substantial ownership stakes. He gains influence or outright control. Small investors buy stocks. Warren buys companies. Take Berkshire Hathaway itself. Originally a failing textile mill, Warren initially intended it as a temporary investment. When the company performed worse than expected, he ended up becoming the largest shareholder almost by accident. The problem was, He didn't know anything about manufacturing textiles, a dying business in America even then. What did he do? He used that corporate shell to acquire an insurance company, then another, transforming Berkshire from a textile manufacturer into an insurance and investment conglomerate. Through restructuring and reallocation of capital, Berkshire's share value multiplied thousands of times over. Warren owned a large percentage of those shares, so naturally his wealth grew proportionally. His approach resembled that of an entrepreneur and business operator, managing cash flows, allocating capital, acquiring businesses, not that of a passive investor clipping coupons. This distinction is absolutely critical. This is why the book Rich Dad, Poor Dad teaches that one should become an entrepreneur before becoming an investor. I don't agree with everything in that book, but this principle is sound. You need to understand how businesses generate cash before you can wisely evaluate where to deploy capital. When you have a substantial capital base, when you own a business generating steady cash flow and passive income, then and only then does investing become truly powerful. First, your capital is sufficient that even modest percentage returns generate meaningful absolute dollars. If I invest $5 million and earn 10%, that's $500,000. I don't need spectacular returns or long-time horizons to make substantial money. Meanwhile, if you're setting aside $5,000 annually from your salary, even if you achieve better percentage returns than me, you may never earn in a lifetime what I earn in a single year. Second, I can access investment opportunities unavailable to you. You can buy publicly traded stocks or mutual funds. I can invest in private equity, acquire entire businesses, purchase commercial real estate, and participate in venture capital. The investment universe expands dramatically with capital. Third, and most importantly, I invest without existential pressure. If I lose money on an investment, my businesses continue generating cash flow. My lifestyle doesn't change. I can wait out downturns or, if necessary, write off the loss and move on. But if you're investing your savings while dependent on job income, a significant loss could be catastrophic. You might lose everything. People have literally committed suicide over such losses. I once thought we could help narrow the wealth gap through education and better financial advice. I've come to realize this was naive. The capital markets operate according to brutal mathematics. The poor can join the ranks of the rich, but it requires extraordinary discipline and often luck. Meanwhile, it's extremely difficult for the rich to become poor. They'd have to make consistently idiotic decisions or suffer extraordinary bad luck. Many people claim Warren didn't have much money before age 60, and that 99% of his wealth was created after 60. This is technically true, but deeply misleading. At age 52, Warren already had $370 million. He was extraordinarily wealthy early on. What happened after age 60 was simply the mathematical inevitability of compound growth on a massive base. This brings us to the three elements of compound interest: principal, rate of return, and time. People obsess over rate of return and time, but the most important factor is principal, the starting capital. Interest rates and time are merely multipliers on your base. Without a substantial base, those multipliers work on nothing. Here's a mathematical reality your teachers may have glossed over. If you earn 100% return in 1 year, doubling your money from $10,000 to $20,000, but then lose 50% the next year, you're back to $10,000. If you lose 50% today, you must earn 100% tomorrow just to break even. In the stock market, which is easier to find, an investment that loses 50% or one that doubles. Losses of 50% are common, doubles are rare. This asymmetry destroys the naive application of compound interest theory. Most stocks follow the overall market. People blame Tesla's decline on Elon Musk's involvement with Twitter, but look at Tesla's chart against market indices. They track closely. Look at Meta, Amazon, Apple. They all follow general market trends. When you buy index funds or actively managed funds, you're getting this market exposure, and periodically, markets undergo significant corrections of 20%, 30%, 40% or more. Warren succeeds because he has enormous capital to deploy and maintains discipline to avoid permanent losses. He achieves roughly 20% annual returns and reinvests everything. My own approach with speculation is different. I take higher risks with smaller portions of capital and leverage, but I withdraw profits rather than compounding them indefinitely. I'm more conservative in this respect because I understand the risk of reinvesting both principal and gains. Apart from operating businesses and marketable securities, I've allocated substantial capital to real estate. Real estate not only appreciates but generates cash flow through rents. Over long periods, returns from well-selected real estate exceed most other investment classes. Real estate is one of the few areas where ordinary people can genuinely apply compound interest principles, buying property, collecting rent, paying down mortgages, and eventually owning multiple properties free and clear. This is more stable than continuously reinvesting stock market gains because real estate doesn't fluctuate as violently. You have a tangible asset generating income. The leverage through mortgages is reasonably priced and non-callable in most cases. This is intelligent leverage, not speculation. Let me introduce a concept I call stream value. Suppose you study vocabulary, learning 10 new words daily. According to financial advisors' logic, after 3 days you'd know all 30 words perfectly. But that's not how memory works. By day 4, you've forgotten a third of them. You retain perhaps 20 words. This is your stream value, what you can actually maintain. The more you learn, the more you forget, unless you implement spaced repetition and active recall. The stock market is filled with experts, yet most retail investors lose money. If you've been to a casino, you understand. When your capital is too small, you're not qualified to play, or if you do play, you're prey for those with deeper pockets. What about real estate? Are there no experts there? Of course there are. The government is the greatest real estate expert through zoning, taxation, and monetary policy. Even the most skilled Wall Street traders cannot guarantee positive returns every year. They will experience losses, and losses compound according to the same mathematics as gains. If you continuously reinvest principal plus gains, even modest losses create significant setbacks. Warren had more capital than you, achieved higher returns than you, but throughout his early decades of investing, he could not afford any major losses. One catastrophic loss could wipe out years of accumulated gains. This is why his first rule is never lose money, and his second rule is never forget rule number 1. In 2020, even Warren lost tens of billions when he bought airline stocks during the pandemic. He could absorb that loss without threatening his empire. Can you? Do you have assets generating cash flow to cover investment losses? Why is compound interest said to be more powerful than an atomic bomb? The mathematics are straightforward. If you invest $100,000 in stocks earning 10% annually, in simple interest you make $10,000 per year. After 7 years you've earned $70,000 total. But with compound interest, you reinvest everything. Year 1, $100,000 becomes $110,000. Year 2, $110,000 becomes $121,000. Continue this for 7 years and you approach $200,000. You've nearly doubled your money. Instead of $70,000 in gains, you've made $100,000. Extend this further. Invest $10,000 today with compound interest, and in 40 years it could grow to $450,000 or more depending on returns. Moreover, if you add $10,000 annually from your salary and compound everything, the results become extraordinary. This investment strategy is mathematically sound. It's based on a perfect model. But if it were this simple, and we've all known about it since childhood, why are so many people still struggling financially rather than wealthy? The answer has been mentioned. Steady profits are difficult to achieve consistently. As Warren says, compound interest requires time, and you must maintain your health and extend your life to benefit from it. If Warren had died before age 60, he wouldn't have accumulated 99% of his current wealth. Who would remember him then? Here's an uncomfortable truth for employees. If you're a salaried worker in your 30s and remain merely a loyal employee, it becomes very difficult to advance further unless you're exceptionally talented or lucky. Everything you accumulate before age 30 essentially plateaus. By your 30s, your position in the organizational hierarchy is largely fixed. Managers remain managers. Department heads remain department heads. The pyramid narrows as you climb. When your position is limited, your salary becomes relatively fixed. You might object, but the company gives annual raises. Yes, your nominal salary increases. Hiring a college graduate might have cost $30,000 20 years ago. Now it costs $60,000. Is this because today's graduates are twice as competent? Number, it's inflation. Your salary increases nominally, but its real purchasing power remains roughly constant. Verify this by tracking prices at the grocery store or for housing. Many governments use this method to adjust minimum wages and appease the majority. They announce, "We've increased your wages," without mentioning that prices increased proportionally. You feel you're benefiting, but in real terms, you've gained nothing. When you're young and lack capital and you cannot control interest rates or investment returns, do not dream about compound interest. It simply doesn't matter yet. I always advise young people to focus on increasing their income, yet most worry only about saving every penny. This is self-delusion. They think that saving guarantees a stable, happy future, but the result is they become part of the 97% whose savings are eroded by inflation and economic cycles within a decade. Warren can leverage compound interest because he uses other people's capital. I invest in real estate using similar leverage, but we do not accept an investment method where you contribute $10,000 annually and wait 60 years to exchange it for $1 million. Our goal is to use initial capital as a foundation to exponentially expand our asset base, not to win big by starting small over agonizingly long periods. Can you see the difference? Here is my sincere advice, which those with life experience will understand. When you have no capital, instead of wasting time trying to grow pennies into dollars over decades, why not focus on investing in yourself? You are the only asset you completely control, and you are potentially the most valuable investment you can make. Do you know how much a true genius is worth? Exceptional talents are scarce and must be competed for aggressively. When I was still active in investment banking circles, I saw that when investors fund outstanding startup teams, they must plead for the opportunity to invest. Founders don't search for investors. Investors hunt for talent. The essence of lack of good projects is simply a lack of people capable of executing projects successfully. Talent is the critical bottleneck. When you're young, if an excellent suit increases your chances of landing a better job, buy it immediately without hesitation. If attending a networking event or business dinner can advance your career, you must participate. Your life has decades ahead. I despise hearing about excessive frugality or penny pinching. People worry about saving when they fear they cannot earn more. This is why I want to point you toward a different direction. While everyone else does the same thing, you must find an alternative path, opportunities that large corporations and institutions overlook. Take the money you would invest in financial products each year and use it as seed capital, combined with investing in yourself, to execute small projects that big firms ignore. Let me offer a concrete example. You could take out a loan or save to purchase a Mercedes, not for showing off, but to become a private driver for senior executives at multinational corporations or wealthy entrepreneurs. Because you own the vehicle, your income isn't merely a driving wage. You can bundle the car rental, fuel, parking, insurance, and maintenance into your service package. Tell clients each month, "Pay me a fixed fee and I handle everything except my personal compensation." Within a few years, you could recoup the vehicle cost entirely. I'm not speaking hypothetically. I know someone who did exactly this. In addition to his primary job, he used the vehicle to generate income during free hours. After several years, he achieved 100% return on his investment. Then he hired additional drivers, expanded to purchase more vehicles, and became a small business owner. Now he has capital to deploy. Of course, this is merely one idea. There are countless details to consider, and you need not follow it literally. Many would candidly say they'd rather die than work as a driver. Moreover, this profession has income limitations. Though I didn't pursue this route, if someone can make it work, excellent. In my view, during the first 20 or even 30 years of life, interest rates and time horizons are less important than the size of your capital base. In the first 2 decades of investing, the returns from interest and the effects of compound growth over time are minimal. What matters crucially is that your capital must be sufficiently large. Without substantial capital, generating significant profits takes an intolerably long time. When you're young, don't obsess over financial investments because your most important asset is yourself. Only when you enhance your own value, your skills, knowledge, network, and earning power, will you never lack money in the future. This is what demands your focus now. Clearly distinguish between what's important and what's urgent. That is how you should allocate your attention and resources. However, I'm not claiming compound interest is unimportant. It is indeed crucial, but only once you have meaningful capital and can sustain profits. The compounding effect strengthens over time. There's a principle sometimes called the Lotus effect. Imagine a pond where Lotus coverage doubles each day. On day 30, the Lotus covers half the pond. When does it cover the entire pond? Day 31. This is exponential growth, the power of compound interest. But notice, this power manifests at the end, not the beginning. In the first 20 years of wealth accumulation, time and interest rate are not the primary drivers. The dominant factor remains your initial capital. What often goes unmentioned in discussions of compound interest and investing is the role of temperament. Warren and I both possess certain psychological traits that contribute enormously to our success. We are patient, we are rational, we do not panic during market downturns, we do not get euphoric during bubbles. This temperament cannot be taught easily. It's partly innate, partly cultivated through experience and discipline. Most people cannot psychologically handle a buy and hold strategy through major market declines. When your portfolio drops 40%, can you calmly continue buying, or do you panic and sell at the bottom? When your neighbor's getting rich from speculation in cryptocurrency or meme stocks, can you resist joining the mania? Temperament matters as much as mathematical understanding. This is another reason why the simple compound interest narrative fails most people. Even if you have capital and time, if you lack the psychological fortitude to stick with your strategy through inevitable drawdowns and temptations, you will self-destruct. You'll sell low and buy high, chase performance, and ultimately underperform even modest compound returns. One of my core principles is that it's more important to avoid stupidity than to seek brilliance. In investing, this means avoiding catastrophic mistakes rather than hunting for the next 10-bagger. Permanent loss of capital is the enemy of compound interest. If you lose half your capital, you must double your remaining capital just to get back to even. How do you avoid stupidity? First, stay within your circle of competence. Don't invest in things you don't understand. Second, maintain a margin of safety. Don't pay full price for anything. Wait until you're getting a bargain. Third, avoid toxic people and toxic situations. They lead to disaster more reliably than good opportunities lead to success. Fourth, don't use leverage inappropriately. It magnifies mistakes as much as it amplifies gains. Most people spend their time trying to figure out how to be clever. I've spent my time figuring out how not to be an idiot. This is a much more reliable path to wealth preservation and accumulation. Another element often missing from discussions of wealth building is continuous learning. Warren and I are learning machines. We read voraciously. We study businesses, psychology, history, mathematics, and countless other subjects. This broad base of knowledge creates what I call a lattice work of mental models, frameworks from multiple disciplines that help you understand reality more accurately. Compound interest doesn't just apply to money, it applies to knowledge. What you learn today builds on what you learned yesterday. Over decades, this accumulation of knowledge and wisdom creates an enormous advantage in decision making. This is an investment in yourself that pays dividends throughout your life. Young people should invest heavily in their education, not necessarily formal education, which is often overpriced and outdated, method, but real learning. Read books, study successful people, learn from failures, develop skills that are valuable and difficult to replicate. This is investing in human capital, and it generates the highest returns of any asset class. So here's the summary of what I've been trying to convey. Compound interest, as typically presented by the financial services industry, is a seductive but often misleading framework for ordinary people with little capital. The mathematics are correct, but the practical application fails for most because they lack sufficient starting capital, cannot sustain consistent returns, don't have the temperament to weather volatility, and cannot wait the decades required for small sums to become large. What actually works is this. First, invest in yourself relentlessly when you're young. Increase your earning power through skills, knowledge, and network. Second, live below your means and accumulate capital as quickly as possible. Third, once you have meaningful capital, learn to deploy it wisely, either by building or buying businesses that generate cash flow, or by investing in real estate or securities with a proper margin of safety. Fourth, avoid catastrophic mistakes that cause permanent loss of capital. Fifth, be patient and let time work for you, but only after you've established the first three conditions. Warren Buffett became wealthy not by patiently compounding a salary, but by aggregating other people's capital and deploying it brilliantly while avoiding major mistakes. That's a completely different game than what financial advisors are selling. If you're young with little capital, forget about compound interest for now. Focus on building your capital through entrepreneurship or high-value employment. Invest in yourself. Find opportunities others overlook. Once you've built a capital base, say several $100,000 or a few $1,000,000, then and only then can you seriously discuss compound interest and long-term investment strategies. This is the reality that most financial education deliberately obscures because it doesn't sell products. But it's the truth, and I've spent long enough on this earth to know the difference between comfortable fairy tales and uncomfortable realities. The choice is yours. You can follow the conventional wisdom and likely end up with conventional results, which for most people means financial mediocrity. Or you can think differently, work intelligently, build real capital, and give yourself a genuine chance at substantial wealth. The latter path is harder and offers no guarantees, but it's infinitely more effective than the myth of painlessly compounding your way to riches from a starting point of near zero capital. I've shared these thoughts not to discourage you, but to redirect your energy toward what actually works. Focus on building capital and capability first. Let compound interest work for you later, once you have something meaningful to compound. This is the wisdom that comes from decades of watching what actually succeeds versus what merely sounds good in theory. If even a few sentences from what I've shared today benefit your life and redirect your efforts toward more productive paths, I'll consider this time well spent. Now go build something of value.